In a period in which the Standard & Poor's 500 stock index has risen steadily for almost 8 years, and with stocks hitting new all-time highs week after week, it's important to remember the relationship between the S&P 500 index and a prudent investor's portfolio. The S&P 500 is the measure of stock market performance and investor sentiment, but it's a poor barometer to apply to a retirement portfolio. It's kind of like using a ruler to measure whether a watermelon tastes good. The S&P 500 is an important metric if you're analyzing earnings or valuations of America's largest companies. But comparing a prudently constructed retirement portfolio and the S&P 500 is apples and oranges. It's mathematically impossible for a diversified portfolio ever to return as much as the top-performing asset class of a portfolio. When you diversify, you'll never get a return as good as the best asset class in which you invest, but you'll also never sustain a loss as bad as that of the worst. And when you're looking at a period of less than 5 or 10 years, returns on a portfolio diversified across all asset classes will lag the S&P 500, especially in a bull market. Dr. Craig Israelson, an independent PhD economist and authority on low-cost investing techniques, whose research we license, recently provided us with one of his studies to share with you. Over the 56 rolling 35-year periods from 1926 through 2015, the large-cap Standard & Poor's 500 returned 11.1% annually versus a 10.4% annual average return on a broadly diversified portfolio. But the risk of the single asset large cap portfolio, its standard deviation, was 18.1% versus just 13.7% on the 4-asset diversified portfolio. That's a good risk-return trade-off. The worst one-year loss in the S&P 500 large cap index was a jaw-dropping 43.3% in the 56 rolling year periods examined by Israelson, while the worst one-year nosedive on the diversified portfolio was a more tolerable 30.3%. It wasn't easy to stay committed to an investment plan in the terrible bear market of 2008 and 2009, but diversifying across 4 asset classes instead of just investing in stocks sharply lessened losses and eased the emotional toll. Over the first 7 months of 2016, the S&P 500, although more volatile than in recent years, climbed steadily higher, and in July it repeatedly broke new all-time record highs. A correction of 10% or more could occur any time, although economic data normally presaging past reversals was not evident. Stay realistic and don't make the mistake of expecting a diversified portfolio to perform as well as the S&P 500, especially if it keeps setting new record highs, as we hope it will.